Good morning, children. In today's topic, we are going to learn about what is capital market. Capital market is a market where buyers and sellers engage in trade of financial securities like bonds, shares, stocks, etc. The buying and selling is undertaken by participants such as individuals and institutions. They mostly deal in long-term securities. It consists of a primary market and secondary market. Now let's see the evolution and growth of capital market. The first phase is from the inception of capital markets in India up to the First World War, that is 1875 to 1919. This phase brings out the initial development of capital market in India. The second phase from 1920, that is the period of Industrial Revolution. It spread over a large part of globe, but India under British rule remained underdeveloped country. This continued till 1947 when India got independence. The final phase started, that is in 1947 independence, and it was up to 1990 the announcement of the new economic policy. The final phase started from 1991 and till the present date. Capital market refers, you can say, it's a place where savings and investments are moved between suppliers of capital and who are in need of capital. Capital market consists of primary as well as secondary market. Now we can see it is traded between investors and the company. Indian capital market evolution began like we saw, that is started from 1875 until date. The period between 1947 and 1973 marked the development of infrastructure of capital market. During this period, a network of development financial institutions such as IFCI, ICICI, IDBI and SIDCs were established. The financial institutions strengthened the capital market. A number of stock exchanges came into existence. We know the first stock exchange, the BSE, the Bombay Stock Exchange, was started, and later on we can see the other stock exchanges came into existence. There were momentous growth in the secondary market. Now we will see the new financial institutions. A number of institutions of finance have been established to cater to the credit requirements of various segments of industries and needs. Some of the financial institutions are venture fund institutions, mutual funds, factoring institutions, over-the-counter exchange of India, National Stock Exchange of India Limited, National Clearance and Depository System, National Securities Depositories Limited, Stockholding Corporation of India Limited. The first one we are going to see is about venture fund institutions. Yatra.com, Mitra.com, First Cry, these form investment, that is they started to give investments to the $1 million to $10 million to Indian based companies as well as companies outside India for new and innovative project ideas. Venture capital financing is a form of equity financing designed especially for funding new and innovative projects. Next we are going to say is what is called as mutual fund. We know mutual fund collects money from people, that is the public, and public they invest, and these people, that is the mutual fund people, they reinvest it into equity or the debt. Specialized financial institutions like LIC, UTI, etc., besides the commercial banks such as SBI and Canara Bank, carry out the business of mutual funds. The benefits of mutual funds are high returns and easy benefits. Moreover, it is safe. We can see that, like the ad in the advertisements in the TVs, they say that mutual funds are subject to market risk. Please read the documents carefully before investing. So sometimes there are some certain risks that are there, but we have to follow even those things. But most probably it is safe. The next one we are going to see is about factoring institutions. What is factoring? We can say, for example, there are two persons, A and B. A is producing or manufacturing shoes and B is in need of shoes. Okay, so for every month, they have for 30 days or end of the 30 days, they have an invoice stating that I am producing manufacturing shoes and they are in need of shoes. So this is a contract between people. But later on, if A wants to expand the project or want to bring into new project, E is contacting C. So C is a factor here. So factoring is an arrangement whereby a financial institution is providing financial accommodation for especially the smaller group of people, those who are in need of. Over-the-counter exchange of India. The OTCEI was set up by the premier financial institution to allow the trading of securities according to the electronic counters throughout the country. Now, the purpose of OTCEI is for smaller companies to raise capital. It addresses some specific problems of both investors and the medium-sized companies. Next, we will see NSEI, that is National Stock Exchange of India Limited. It was established in 1992 as a function as a model stock exchange. The exchange aims at providing the advantage of national-wide electronic screen-based, scriptless and floorless trading systems in countries. It was set up by the Ministry of Finance for clearing and depository function of the stock. Next is National Clearance and Depository System. Now, under this scriptless trading system, settlement of transaction relating to securities, it took place by the book entry. The next one is National Securities Depositories Limited was set up in the year 1996, a time-bound dematerialization as well as rematerialization of shares. The establishment of NSDL is expected to elevate the problems of post-trade in the secondary market. Stockholding Corporation of India Limited. Stockholding Corporation of India Limited aims at serving a central securities depository in respect of transactions on stock exchanges. Now, it also takes into account the administration of clearing functions at the national level. Next, we should know what is gilt-edged. Gilt-edged market, also known as government securities market. Now, we can see this securities market. Gilt means, we can say gilt is a thin covering of gold. So securities or bonds are issued by the United Kingdom, that is UK government. The term is of a British origin and then they refer to the debt securities. It is issued by the Bank of England on behalf of His or Her Majesty's Treasury, whose paper certificate had a gilt. That gilt is a border that is a covering of gold. Hence known as gilt-edged security. These are government securities and they are very safe to be used. Okay, we can use these securities. Guarantees are there on the returns. No speculations in securities. Institutional based investors were compelled by law to invest a portion of their funds in these securities. And we can say LIC, GIC, PFs and some commercial banks are a part of this. Heavy volume of transaction necessitating negotiation of each transaction. Next, we will see what is foreign exchange market. It's a global, decentralized and over-the-counter market for the trading of currencies. This market determines foreign exchange rates for every currency. The foreign exchange market abets the foreign exchange trading. It is the largest, most liquid market in the world with an average traded value of 5 trillion per day. Okay, now this includes like currencies all over the world. Okay, every part of the world, currencies are exchange rates are known by this foreign exchange market. Next, we will see commodity market. The commodity market manages the trading in primary products, which takes place in about 50 major commodity. Now we have hard commodity as well as soft commodities. What are hard commodities? Hard commodities are raw materials mined such as gold, oil, iron, etc. Soft commodities are typically grown agricultural primary products. What are they? Wheat, cotton, coffee and sugar. Next, we will see derivatives market. Derivative markets facilitates the trading in financial instruments such as futures, contracts and options used to help control financial risk. The instruments derive their value mostly from the value of an underlying asset that can come in many forms. Stocks, bonds, commodities, currencies are examples for derivatives market. derivative markets, the value of underlying assets keep changing accordingly to the changing market condition. The basic principle behind entering into derivative market contract is to earn profit by speculating on the value of underlying asset. We'll do a recap of what we have learned today. In today's topic, we learned what is a capital market, the new financial institutions, and we saw what is gilt-edged, and the last one we saw the foreign exchange market, commodity markets and derivative market. Hope you have understood this topic, children. Have a nice day.